Okay, so you've decided that you need capital for the operation of your business. You need working capital. You need a loan. You've decided that you need to go to a bank, or if you listen to episode 1 or 2, you're thinking maybe I need to talk to a private credit organization. Well, before we jump into that, let's jump into our disclaimer that we provide during each podcast. This podcast is for educational purposes only and does not constitute financial advice for your specific business or personal endeavors. Gilman Bagley and the people appearing on this show are not liable for your results from the content we present in the episode. If you want specific recommendations, contact us directly. See our contact information in the show notes or go to gbgovconfunding.com. And while you're there, you'll probably notice a few things about us. We provide fast and flexible financing solutions to small businesses and lower middle market companies that allow them to access working capital by leveraging their business assets. And we've provided more than $500 million in private credit to our customers with fast approvals and sometimes same-day funding. And we did all of that with more than 100 years of private credit, business growth expertise, and some great GovCon funding expertise as well. Okay, folks, so welcome to episode 3. Joining us today is our co-founder, Matt Gilman. Matt, welcome back to the show.
Thanks a lot, Tony.
All right. Well, we're going to jump into some really fun stuff here. We started at kind of the 30,000 foot level with episodes 1 and 2, and now we're going to push the nose down a little bit more, and we're going to dive into the differences between a bank and private credit. We're going to really drill down on this. And this is for folks who have decided, okay, I don't want a credit card to pay for some of the things in my business. Maybe I want a new contract. I need to hire employees. Can't do that with a credit card, most likely. And I don't want to give up equity in my business to a venture capital, a private equity organization, but I know I really need working capital to hire those employees, get them on contract, or maybe you have some CLINs that require you to buy equipment for that new contract. Well, now you're thinking, okay, I need working capital to do that. I need to go to a bank or I need to go to private credit. Now, let's talk about some of the key differences between a bank and a private credit. And we're going to go through some pretty significant differences between the two. We won't drill down into a lot of detail in each one of these. We'll cover a lot of those in the following episodes. But before we do that, let's talk about some of the words that are used to describe banks versus private credit. Okay, a lot of folks know what a bank is. You have a bank. And listen, if you are a government contractor or want to become a government contractor, well, step 1 is if you want to win prime contracts, you have to register in sam.gov. And what does sam.gov require? Well, there are 3 things. I just checked it out. It hasn't changed since I started my GovCon business almost 20 years ago, and I had to do this. And there are 3 fundamental things you need. 1, you need a company that is actually registered and filed with a state. So you need the legal business name, you need the date of incorporation, and you need to indicate the state in which you incorporate. The second thing you need is you need a taxpayer identification number. That's what you're going to get from the IRS. And then finally, the third thing you need, guess what? It is a bank, electronic funds transfer account information, the account number, the routing number, that type of information. Those are the 3 things you need. And so you're going to have to start off with having some sort of a bank account if you're a government contractor seeking prime contracts. And so you know what a bank is. We talked about private credit in the previous 2 episodes, but let's talk about some of the terms used to describe them. And this is where people want to sound fancy. Maybe it's other bankers, maybe it's folks in the private credit world, or maybe it's just folks thinking they just want to impress you. And so let's talk through some of these terms here. So a bank, you can also describe a bank as a depository lender, meaning they're lending based on the deposits that they get from their customer. You can also hear the term deposit funded lenders or a traditional lender. And then you can hear the term of regulated depository institution or a commercial or retail bank. So now let's talk about how these are in contrast to the terms described as private credit. So depository lender, when you're talking private credit, it might be described as a non-bank lender or maybe a non-depository lender. And then you may also hear it addressed as an institutionally funded lender, or could be considered, as a contrast to traditional lenders for banks. Private credit could be called alternative lenders. And then it could also be considered private credit funds or a direct lender. So those are some of the terms describing private credit. There's some of the terms describing banks. Don't let those confuse you. Sometimes they can be overwhelming. If they ever do, just come back to episode 3 and look at the list that we provided to you. All right, Matt, let's jump down this list here and let's talk through some of the differences between banks and private credit. So let's start off with the first one here. Typically a bank may be your lowest cost of capital versus private credit. As we talked about before in episode 1 and 2, there's a lot of flexibility provided with private credit. And there's a faster speed typically in which credit is provided. So you're going to pay for that extra speed and that extra flexibility. So you're going to pay a little bit higher cost of capital. You're going to pay a little bit higher interest rate typically than you would with a bank. Anything you want to add to that, Matt?
No, I think that's spot on, right? I think with flexibility and speed, right, is going to drive in many ways its cost. But the other thing is when you look at a alternative lender or private credit versus a bank, if you take just a little bit of a step back and you think about your business, a business that's staffing people is a margin on people, right? You're marking up your cost of goods, which is, people and whatever other SG&A there is. And when you look at alternative lenders or private credit, it's really the same thing, except, the inventory is money. The money has a cost to it. And the private credit companies are out there marking up their cost of funds. So naturally, a bank is going to have the lowest cost of capital. They're going to have, obviously a lower cost of goods. Whereas you look at, a private credit fund or an alternative lender or a company like us, we turn around and we have to borrow money from a bank. And after we borrow money from a bank, we turn around, mark it up, and then have to focus on providing a really good service, providing creativity, flexibility, speed, and making sure that we can have differentiators aside from just cost of capital.
Yeah, I like what you also said there, Matt, about how the mechanics of how private credit works. Where as a private credit provider, you're typically receiving capital from an original source. Maybe it's from another bank, and you're essentially reselling that capital to companies, to the government contractors that need that capital. So I'll put it in GovCon terms. We're the prime. The bank is the sub because we're adding that pass-through rate in GovCon terms to the capital that we get from our bank source. And private credit providers get their capital from many different sources. We'll probably make that a topic of discussion in one of the future episodes. I think that would be really illuminating, Matt, for some of our listeners to hear. How does private credit actually work? How does that machinery work? And if you're watching some of the headlines in the markets, you're probably hearing some things about private credit too. And those are probably more associated with those publicly traded business development corporations and larger private credit institutions. So maybe we'll dive deep into that topic for the private credit nerds that are out there who want to know how it all works. But I'm really glad you brought that up. Another thing I'd like to bring up too in this lower cost of capital with the bank. And we mentioned this in the past episode number 2, right before this episode. It's not necessarily cheaper. Okay, let's talk about smaller businesses. For SBA loans, you're actually going to pay a higher spread, if you will. It's that difference between the banking rate that's listed with the Federal Reserve. As of last week, it was 6.75%. I think it's still at 6.75%, Matt. And what we talked about last week is as that loan size gets smaller. That's a perceived risk on the part of the banking institution. So they could have a spread on top of that, meaning they could add 6 extra points on top of that bank rate. And so now you're up at 12, 13%. Now you're pushing into the range and maybe even higher than some private credit providers out there. So we say banks are generally cheaper, but that's not always the case. Okay, Matt, let's jump into
this. Tony, if you don't mind, I just have a couple more comments on cost of capital, because I always think it's such an interesting topic, because comparing just apples to apples, cost to cost is one thing. But sometimes you do have to turn what the cost in terms of interest rate is into actual dollars. And I think a lot of times people don't do that. They look at only the face value of like, what is that interest rate? And to give you a really good example, let's just say a bank is at 8%, right? Let's give a good moderate, right down the middle rate, 8% today. And you have access to $200,000, right? If you want to say
a line of credit, right? You got a $200,000 line of credit. They're charging you 8%.
They're charging you 8%, right? So you'd sit there and say, okay, well, 8% if I borrow the entire $200,000 for a year is $16,000. If I went with a private credit or an alternative lender, right, and it was a non-bank lender, let's just use that terminology here, a non-bank lender, and it costs 12%. It's not 12% or 0, it's 12% or 8. The difference is 4%, right? 4% of $200,000 is $8,000 a year. Now, $8,000 is real money. The question is, where's the benefit? I would sit here and say, if I was a non-bank lender providing $200,000 and you had an identical offer from a bank providing you $200,000, why would you go with an alternative lender? The answer might be, you won't. There's no reason, right? An alternative lender has to offer something, right, that a bank might not. The bank might offer you $200,000. The alternative lender might offer you $500,000. So if you have $500,000 of capital, does that impact your ability to go grow your business? And for a 4% difference in rate, can you grow by an extra $2 million in revenue with that capital? And is your margin 35%? Right? So does a 4% increase of capital on $500,000 give you the ability to go win business and earn 35% on an extra $2 million of revenue? You sit there and you look at not necessarily the cost of capital, you look at the opportunity cost of not being properly capitalized.
Yeah, that's great. And to use that analogy again in prime contractor versus subcontractor GovCon terms, okay, you have an opportunity to pursue contracts. Now, you can do that singularly as a prime, no subcontractors, no partners, or you can bring on partners and grow faster. Which do you choose? You're going to have to give up some of your profitability, some of your direct revenue, because you're giving that up to the subcontractors that are on your team. You know that. But government contractors do this all the time. We know you need to team in order to win, because those teaming partners bring added value to the relationship. And so it's very similar here, is thinking in those terms. I love how you say it, Matt, is, you're going to pay in a different interest rate, but you may have access to more capital. And other great benefits.
But your example there, Tony, I think is really perfect, right? It's just when it comes to money, people sometimes get sensitive and they think about what they're trained to think about, which is the cost of funds, and yes, there's a level at which cost of funds can go crazy, but that's not what we're talking about here. But with money, people are always trained to kind of like look at those details. But when you're a government contractor and you have an opportunity to grow, you sit there and you weigh your options and you say, okay, I can do this work myself. I can self-perform, right? Which is no different than saying, maybe I have my own money. I got to put my own money into it, which is a separate opportunity cost. But you sit there and you say, okay, I'm gonna sub out 50% of my work. And you might be making half the margin on it. That's a whole lot more expensive sometimes than having the proper line of credit to go hire your own people. Because people will use subcontractors because they don't have the same payroll cycle, right? They might be able to pay their subcontractors on net 30. And if they pay subcontractors net 30 or net 45, the subcontractors are carrying the payroll expense. But if you add up what your cost is because of your reduced margin, you sit there and say, oh my God, by paying a couple extra points of interest rate, I would make so much more money if I took this in-house.
Yeah. Well, hey, this is the reason why we have this show, Matt, is to kind of explain a lot of this because, hey, let's face it, they don't teach you this stuff in high school. They don't teach you this stuff in college, a lot of college courses. Heck, a lot of this stuff I've learned over the past several years operating in the banking world and the finance world. I didn't even learn in my MBA program. So these insights are, I think, really helpful for a lot of GovCons. And you need to know these numbers, folks, as GovCons. I don't care if you're just starting off or if you're, a multi, tens of millions, even hundreds of millions of dollars in revenue. You need to know this. You really need to know this. Even the business developers out there, you need to know this because this can directly impact your ability to go out and win business. So, okay, Matt, let's keep the ball rolling here and go on to the next thing here. And that's the speed of approvals. Now, there's no hard and fast rule on this. Yeah, but generally, a bank is going to take some time. They're going to take about 4 to 6 weeks. The bigger the bank, the slower they go. We all know this. Big bureaucracies, prime contractors, government contractors. You know this. You work with a large prime contractor, one of those top 10. It's going to take a lot of time. There's a lot of paperwork and teaming agreements, NDAs, you name it, and building those relationships. And the smaller you go with the banks, they might move a little bit faster. They have a less of bureaucracy, but generally banks they have to go through a complicated credit analysis, underwriting process. The banker you're dealing with, that person is the front end of the bank. Then they have to engage with the credit analysts who are completely different departments, the underwriters that are separate by design because they don't want them being influenced unnecessarily in making poor loans. So there's a lot of bureaucracy within those banks. Private credit, you're going to find generally they can move faster. Sometimes with our corporation, with Gilman Bagley and GovCon funding, we can move sometimes in a matter of a couple of days. But it's going to be relatively faster than what you're going to experience with a bank. Anything to add to that, Matt?
No, and I always give the caveat that banks offer a great product for the right company at the right time, right? And I think that's the big thing to keep discussing is banks serve a purpose and we serve a purpose. The question is, where are you in the life cycle of your company? If you want to act quickly, if you want to move fast, or if you have a fast growth trajectory, you need less bureaucracy, right? Like you need to talk to people who are the decision makers. And frankly, the big difference is banks make money in a whole lot of different ways, right? We only make money by putting capital on the street. So when you look at alternative lenders and non-bank lenders, their sole or core source of income is providing you with capital. If they cannot provide you with capital, they don't make money. A bank has many, many, many different revenue streams. So they don't operate the way that we operate because our lifeblood of our business is providing capital.
Yeah, that's a great point, Matt. Banks, they have other products like credit cards they'll provide to your business. Of course, there's the cash deposit that you have and the treasury management services that they provide. So many different wire transfer products, you name it. There are a lot of products that they have to generate revenue, and you need those products. We're not saying you don't need to work with a bank. You definitely need a bank. We clearly stated that as a government contractor, you need them. Yeah. So it's not that it's not one or, it's a one and. Okay, so let's jump down to the next one here about rigid criteria versus flexible criteria. What do you mean by flexible criteria, Matt?
Yeah, and this is that same example, right? So when you look at a bank typically wants to see that historically your financials can support the line that you're looking for. And that's great. Again, that's awesome for a stable, 5% growth per year company that's been around for a long time. But we all know in the government contracting world, you can go from 0 to 100 very fast. And what does that mean? That means that your historical financials show 0, your future shows 100. Now, how are you going to support that? And the answer isn't a bank line, right? The answer is an alternative lender, because somebody who could provide that capital, that understands government, that can look at the future and say the value of your contract, the what you're going to bill, right, in the next 30, 60, 90 days is tremendous. So criteria plays a major role in how you're looking at a deal. We all have criteria. They're all boxes that we need to check. They're all things that we look for. And many of the things that a bank looks for and we look for are similar, right? Credit and lending has been around for a very long time. But the question is, how is our product structured to support the companies that need us today? Whereas in the past, they didn't have the revenue or didn't have the opportunity that they have going forward.
Yeah, I like how you contrast between banks as backward-looking and private credit can be forward-looking and addressing your growth. And in some situations, some banks may consider rapid growth actually a risk factor in their credit analysis process. So,
and by the way, it is.
Yeah. Right? It seems counterintuitive, right? As a GovCon, I'm thinking, hey, I'm winning a lot of business here. Why does not my bank doesn't want to support me? I don't get it. And it seems counterintuitive. And you're thinking, I'm growing. Why they should be loving this. But yeah, and
that's where some of our, Tony, that's where some of our criteria and what we look at is, it's not just, oh, there's opportunity. Sure. Here's the capital, right? Like, we also have to understand, like, who's the company? Can they perform? Because, we look at times companies don't go out of business. They grow out of business, right? They take on too much work, right? And all of a sudden they don't have the non-billable infrastructure, right, of people to support the invoicing, the HR, the and all the growth and operational mechanics that will occur when they go to that next level of business. So we look at that and we understand it, and we sit there and say, this company knows what they're doing. We're not worried about it, right? So let's see if we can help provide some, fuel to the fire and help them grow. But I think banks, for the most part, will look at that and say, just not in our box.
Yeah. And that's a great emphasis. Look, private credit, banks, lenders always will go through a credit analysis underwriting process. And there's a significant amount of analysis that goes into each particular specific situation. That's why we say in our disclaimer, you can listen to the show, but it's not going to be specific to your outcomes, to your specific needs. All right. The next area here is rigid terms versus, we're talking about fees in some ways. We talked about the terms, but let's jump into the fees. Generally with a bank, you may have transaction fees. Private credit, you may have less or no fees. What are some of those fees that you think private credit generally will not charge versus what a bank would charge?
Yeah, I think size generally plays a pretty good role there in terms of what size facility or line of credit you're looking for. But normally I'd say the big fees that are a difference is really like your legal expense to close a deal. Talking about the one-time front end expenses. We don't have any legal expense. We generally have documents that are already in form. Whereas you have a lot of banks that will have same boilerplate documents that are already in form up to a certain size. And then once you kind of break into a larger size, there's usually legal that gets involved where you're paying both the bank legal costs as well as your own. So I'd say like fees really come into size, right? The smaller deal, the more boilerplate the transaction looks. And then ongoing fees, you usually do have with a bank more statement fees and transaction fees. But generally speaking, I'd say that it's really the upfront, or one-time fees that cause the difference.
Yeah, that's a big part of our show here, is making you educated consumers and letting you know to ask each one of your lenders as you're going through the process. Is ask them, what are their fees? Ask up front. They should be able to give you those list of fees and a sense of how much those will cost for you. The next area down the list here is about industry expertise. Now, banks and bankers, you're going to find generally that the banker you're dealing with is talking to a lot of different companies and a lot of different verticals every day. And that's fine. That's great. You want that broad general knowledge. It gives you a good sense of what's going on in the marketplace. It can give you good benchmarks and assessments versus other industries. Even maybe within your industry, they can give you some good benchmarks too. But when you're talking private credit, there's the opportunity to have more specified expertise. And so at Gilman Bagley, we have GovCon funding division, and that's where we have that specialty with folks who have been government contractors like myself, working in business development as an operator, as a GovCon owner, and then Matt and the co-founder Michael Bagley's background lending to a lot of government contractors. What are some of the other industry expertise capabilities that private credit brings to the table, Matt?
Yeah, and I think that one's across the board too, with every industry, bank or non-bank, and all different types of services. I think when you want to find somebody to work with, you have to start with people who have an expertise in your actual industry. You know, we have people who come to us that are in industries that we're just not experts in, right? And we end up spending more time trying to learn a business than being able to provide a solution. And I think that's it's a more challenging relationship when both parties don't fully understand the industry. And some banks, of course, have specialty government divisions. They know the business. They're good at it. The question is, are you right for them? Are you the right size for them? We consider small government contractors to be, 1 to 10 million, 1 to 20 million in revenue. And a lot of banks consider small government contractors to be $25 to $100 million in revenue, right? So the word small is used very differently across the industry. But I would always ask, I'd look at people's titles. I try to understand, right? Like there's the bank and then there's the banker. Talk to your banker, right? Like you should have, your banker's your champion. Your banker should be the person who's out there saying like, we're really good at this. We can help you. But also ask them like, do you have other customers that do this? If they don't, then like you really need to make sure that you're in the right home, because a bank that might have, or even I say both, right? A bank or a non-bank lender that dabbles in an industry can unilaterally decide at some point they don't want to be in that business. And if they decide that, you're going to be hit by some macro change and you're going to be negatively impacted. Whereas if you work with a company that this is what they do, or a bank that has been historically known for this is the business they're in, then I think that's a good choice. But going to somebody who, dabbles or has some expertise, sometimes even at non-bank lenders, what you find is somebody at that company has the expertise, and when they leave, the expertise kind of goes with them, and that's a risk too. So just make sure that whichever company or bank you're deciding to work with, they know what you're doing, and you'll find that by the questions they ask, right? Not only by what they tell you, but what questions are they asking you about your business? And are the questions that they're asking make you say, oh, these are experts in my industry? Or do they make you say, why are they asking that?
Yeah, the questions are profound indicators of capability and competency. And I like how you say, again, the show is about educating consumers of the different products, and have that conversation with your banker and ask them, do you have a government contracting specialty team? And they may say, oh, yeah, we do. Oh, okay. Well, who are they? Well, they're bankers who have been lending to GovCons for a long time. Okay. Do you have any other people on the team, maybe with actual operational knowledge, maybe worked at government contractors in the past and they really understand my business? And so there are some banks that do have some GovCon teams. Ask that question, shop around. They're out there and they can provide you a lot more support than just selling you products. They can connect you with key partners in the industry. They can introduce you to other service providers to help you advance your business. There's a whole lot more to your lender than just what you see in that contract and that interest rate. And we have a couple more items here on the bullet list, but we're talking personal guarantees, covenants. That's more of a teaser for future episodes as we deep dive into a lot of different elements of private credit and banking. And we'll continually do that as we move forward, because there's a lot of comparison and contrast and collaboration that takes place between private credit and banking. And at the end of the day, understanding some of these key differences makes you a lot better at shopping around and finding the best solution for you. Matt, anything else you'd like to add?
Yeah, just the last thing I'd like to add is when you go out looking and you go to meet a bank or a non-bank lender, I understand that you might be searching for today, but you do have to ask a lot of questions about the future. Because if you go to a bank and they provide you with a signature line for $100,000 today, that might solve today. But you should ask that bank, because they might be the right place, right? This podcast isn't about promoting our product only, right? This is educational about what exists in the market so that you can make good and educated decisions. Look at the banker, talk to the banker and say, okay, this is great that you're going to be able to help me today with a $100,000 line. Do you have a group that does $500, $1 million, $2 million, and $5 million lines so that I can graduate within? Because you don't want to go leave your bank and go somewhere else. You want to try to stay with whoever it is that you're working with. So ask them, if I come with you today, what else do you offer as I grow?
Yeah, great advice. Focus not just on the past, but on the future growth of your business. And hey, if you have some questions about the future growth of your business, maybe you want a new contract, maybe you're bidding on a new services contract or a new equipment contract, well, reach out to us at Gilman Bagley and we can have those detailed discussions with you about your own personal specific situation. Matt, thanks you for joining us on the show, and thanks to everyone listening, and we'll see you in the next podcast.